Ladies and gentlemen, good day and welcome to Aditya Birla Sun Life AMC Limited Q4 FY22 earnings conference call. We have with us today from the management, Mr. A. Balasubramanian, Managing Director and CEO, Mr. Parag Joglekar, Chief Financial Officer, and Mr. Prakash Bhogle, Head Investor Relations. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. A. Balasubramanian for his opening remarks. Thank you, and over to you, sir.
Yeah. Thank you, operator. Thanks for the introduction. Good evening to everyone for attending this investors call. I hope you all had the opportunity to go through the earnings presentation, which is available on the stock exchange as well as on our website. Let me first begin with the economic outlook and mutual fund industry update. FY 2022, as you all know, turned out to be the mirror image of last year with the growth rebounding from 2020 pandemic lows. And world over, policymakers have been adopting policies that support growth, but with the rising prices, we expect to see some kind of tightening of policies. The geopolitical factor and the developments is also now determining the global supply chain and commodity prices in general, leading to an inflation. And inflation in India too, much like the rest of the world, has been on a rise, but has largely remained within the RBI tolerance band. Higher inflation has been due to high commodity prices and global supply disruptions due to geopolitical crisis. So far, we have seen an accommodative stance with the RBI on account of higher preferences for growth. But with increasing pressure due to higher prices, we may see a change in preference from growth to inflation. And high inflation hawkish RBI, a sharp increase in bond yields in developed markets, and large borrowing program have caused interest rates in India to rise moderately. And also the exports and imports both jumped sharply in FY22 as is known because of the oil prices, demand for gold and strong global growth supported both imports and exports. As a result of that, India's trade deficit rose from $103 billion in FY 2021 to almost $200 billion in FY 2022. The current account deficit as a result of that also widened to 1.5% from 0.9%. And going forward, oil prices, in our own belief, will be the most important variable for the Indian economy, has the same impact on India's GDP growth, inflation, as well as the balance of payment dynamics. In terms of impact on economic growth, given that duration and the impact of the geopolitical conflict is highly unpredictable, we can see downside risk to India's growth forecast in FY 2023 if the negative shock does not get extended beyond a point. On the market front, the valuations have corrected but remain close to long-term average. The heightened geopolitical conflict has also led to elevated FIIs outflow from India, but the same has been offset by strong domestic institutional buying within the same period, which is supporting the market. For the next few years, India is likely to go back to its real GDP growth of the pre-pandemic levels with all these three drivers of economy, namely consumption and investments and exports firing. Therefore, I would remain optimistic on India's coming back then maybe in the year to FY 2022 and beyond, and therefore attracting more and more foreign flows into India, as well as the Indian mutual industry to continue to grow on the higher path. With respect to the mutual industry, during the quarterly average assets under management for the Indian mutual industry at an all-time high of 38.30 lakh crores as of March 31, 2022, as against 30.19 lakh crore as of December 31, 2022. In a sense, overall we saw a flat market in the last quarter of the current financial year. Which again on a year-on-year basis grew by over 20% from 30 lakh crore as of March 2021 to March 2023 lakh crores. In FY 2022, the mutual industry witnessed good inflows across various equity schemes. A significant proportion of these inflows have been contributed through the launch of new schemes by various mutual funds across different categories. In fact, the total money raised to the NFOs is to the extent of about 1.08 lakh crores. The retail participation from both the T30 and B30 cities have remained strong during this period. As on 31st of March 2022, the total number of mutual fund investors stood at 13.1 crore versus 9.9 crores on as of March 31, 2022. It's an increase of about 33% on a year-on-year basis. As the continuous promotion of SIPs has created a significant momentum in the monthly SIP contribution. In fact, overall monthly SIP book has hit a record high of over 12,400 crores in March 2022. The industry witnessed strong net equity sales of 90,000 crores in the Q4 of FY22 through a mix of new fund offerings as well as existing funds receiving flows. This trend has consistently played out over the past few months within the existing equity schemes and hybrid categories and flexi cap categories and multi-cap and sectoral funds and dynamic asset allocations. These are the schemes generally we have seen net inflows coming into the mutual fund space. The retail investor surge is also reflected in higher individual average AUM, which grew by 21% year on year and contributed to 55% total monthly average AUM. The mutual fund average AUM for March 2022 from these 30 cities was 17% of the total AUM. The SIP registrations were around 71 lakhs in the Q4 FY 2022, which again gives us the confidence for the future of the growth of the industry. The total number of SIPs accounts as on March 31, 2022 was around 5.28 crores for the industry as a whole. Coming to the Aditya ANC performance, our total average AUM for the quarter ending March 2022 stood at 3.07 lakh crores with a yearly growth of 9%, mainly on the back of robust contribution from the equity segment. However, quarterly average AUM, total AUM growth has seen a dip due to marginal year-end outflows in some of our fixed income funds. Our equity mutual fund AUM grew by 25% on a year-on-year to 1.1 lakh crores for the quarter ending March 2022. Our equity mix as it stands today is about 41% of total assets under management is coming from equity. As is stated, the customer acquisition remains an integral part of our strategy. We added around 13 lakh new folios in the whole year of FY 2022, and with this, our total overall folio has increased to 79 lakhs, almost touching 80 lakh folios as it stands today. Our equity performance, which again key integral part of our success of AMC, has seen a significant turnaround across all categories. In fact, our dynamic asset allocation fund, sectoral and thematic fund category, we have seen AUM growth through net inflows driven by strong performance. To better serve our investors and give them the best investment experience, we have made few structural changes to the investment team on the equity side with the two co-heads managing and mentoring team of analysts and fund managers, which we believe will bring in high level of contribution, accountability, as well as the responsibility in terms of driving aware not only the investment performance, even the connection to the external world. And recently, we held our 9th edition of our flagship investment conclave voyage. In fact, we have been doing this since the last 9 years. We generally the people look forward to this with one of our signature events. We have received a very good response on this event, which happened last month. The event had eminent speakers from all around the world with diverse backgrounds and experiences to share the knowledge. Our investment management team provided great insights into the economy, markets, and what strategy one must follow for a good investment experience as part of our value addition to both our investors as well as distribution partners. As part of our scale initiatives, we are constantly working towards leveraging the potential of our existing products as well as launching new product to build size. Over the last few years, our focus has been growing our retail franchisee, increasing the wallet share from B30 cities and building our SIP book size. As part of this continuous drive, we implemented various initiatives and they are as follows. We have seen significant traction from our Harghar SIP, that's the way we started our campaign to drive our SIP, along with our existing Win with SIP as a campaign. We're also creating awareness about the multiple SIP, rather multi-SIP I can call it, feature that uses the process of investing in multiple schemes as well as acts as an effective tool for goal-based investing. Through this effort, our monthly SIP book has increased from 794 crores as of March 2021 to about 894 crores, just short of 5 crores to 900 crores in March 2022. We have registered around 3.24 lakh new SIPs during the quarter ending March 2022. As a result, we now have about 32 lakh live SIPs with us as on March 2022. Through our VRM model, which is nothing but virtual RM model, we have activated around 2,500 distributors across the country. In fact, our virtual RM model today are currently available to activate IFAs in about 14 languages in about 16 touch points that we have created across the country as part of our expansion drive in activating more IFAs to work for us. With our service to sales model, which again we introduced one of the new initiatives in the beginning of the year, we are focusing on building the right skill sets of our client relation executives to engage effectively with investors and facilitate their investment decisions. Currently, we have around 100 dedicated personnel under this model to guide investors and address their every need in order to get our service relationship with the customers increase significantly and therefore increase our mind share, which ultimately lead to increase in market share. Our distribution expansion initiative is called as Sampark, has empaneled over 5,000 distributors in the current year, especially the people who have been, of course, getting onboarded to the mutual funds as the IRN holders. And they are, of course, getting this empaneled with us to a special initiative called Single Click Empanelment. We have seen a good success on that, which again adding to the overall success of the AMC. Through our investor education initiatives, which has been one of the pioneer division that we have created, we also set up various programs for the bottom of the MFD's fraternity, which again remains a continuous ongoing process for us to reach out to more on customers, one creating awareness, as well as increasing the mind share and the market share. We are also happy to share that our efforts have worked out very well with the contribution of retail franchisee, increasing to 48% as on March 2022, compared to 43% about 5 years ago. Similarly, the contribution from B30 markets, which used to be about 14% 5 years ago, today is stands about 16% as of March 2022. In order to increase the retail sales contribution further and bring in a sharper focus on high potential markets, this year we have divided the country into 5 zones. A special focus has been given to Mumbai and Delhi, which generally we call it the P2 in our systems, as a separate zone. As these markets both combined put together, contribute overall about 40% of the overall retail market. Therefore, we have brought in a special emphasis and special focus in order to have a sharper engagement in Mumbai and Delhi, and therefore current zone, and rest of them actually is divided into 4 zones, which again continues from a retail franchisee penetration point of view. We also created in order to serve the large pool of growing HNIs. We carved out a separate team of people to focus on this segment and have been introducing specialized products and services under the brand name of CARE to cater this segment of the market. Therefore, our sales team is made to work around the new model and structures in order to increase them, reward them, recognize the top talent, while also creating a collaborative spirit among the team for higher engagement and synergy, and therefore can lead to an increase in overall productivity in the coming year. With respect to alternate assets, which again have been guiding everyone that is one of the key area of focus that we bring in, I'm happy to inform you that our passive product has been yielding a good result. In fact, our overall passive as a category has gone up by 6 times from March 2021 to March 2022 to touch almost about 10,000 crores, just short of about 38 crores with respect to our size, about 9,961 crores is the size that we have reached as of March 2022. Our emphasis on building our passive strategy also has gained momentum by way of launch of more products through ETF, fund of fund, and multiple index funds. Our customer base in this category has also now grown to about 3,98,000 folios, which again reflects on the approach that we are bringing in order to take the ETF as one of the products as alternate investment solutions to customers. It's also now beginning to yield as a result. Currently, our passive offerings can be bucketed into 4 categories oriented towards the fixed income, equity, hybrid, and commodities. After gaining significant traction and scale, we plan to launch smart beta passive products, which have comparatively higher margin and can contribute to overall profitability as we move forward. As far as the offshore fund concerns, last time we did make a mention that we are making some changes. In fact, since the time the gentleman in Sarat Satkumara was a seasoned global emerging market money manager as our international CIO, we have been engaging with various funds both in Singapore and other markets to launch our fund called the Greater India ESG Engagement Fund. We already launched this fund in terms of our roadshows, and hopefully this should also now see some kind of success in the coming quarters as part of our contribution coming from the global market. On the PMS and AIF front, first and foremost, we have a suite of products like service sector leaders AIF, and market-linked debentures PMS and credit opportunities fund in our pipeline. While we continue to do that, even existing PMS, there may some new changes in our team in order to drive the PMS as an asset class as for next level of growth. I mean, once the current recruitment are really done, once he is on board, and we will bring in some kind of aggression on the PMS front as we move forward in terms of launching new products, as well as products that could be profitable for us, as well as suitable for the customers. On the real estate front, I am happy to share that we have completed our first close on Aditya Real Estate Credit Opportunities Fund. And in fact, we closed the fund at about 160 or 170 crores in terms of size. And hopefully this fund will be going actually being taken to the overseas market. In fact, in the coming year, 2022-23, we'll bring in more assets in the same fund as we move forward. Now moving to the financials for the quarter, our focus continues to remain achieving a robust asset mix of high margin equity assets and long-term debt. We would like to reiterate that our equity mix is an all-time high of 41% for the quarter for the quarter ending March 2022. ABS and AMC in fact registered highest ever profit in FY 2022. During the financial year 2022, the total revenue has improved by 17% on a year-on-year from 1,200 crores to 1,409 crores. Our profit after tax has increased by 28% year-on-year from 526 crores to 670 crores in the FY 2022. And we are happy to announce the board has also proposed 5.85 rupees dividend as the final dividend for FY 2022. With this, the total dividend declared for the full year about 11.45 per share. For FY 2022, our overall investment book stood at 2,121 crores, and in fact, the year of 2021-22 has gone quite well, both in terms of having the right asset mix, highest ever profitability, overall improved asset mix, and reasonably good momentum that we have built in the last few quarters in building our SIPs. All of them actually are going in the right direction in terms of building up this next level. With this, I would like to just conclude my briefing and now open the floor for any questions that you may have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, hi. So just wanted to understand a couple of things. Firstly,
sorry to interrupt you, Mr. Jain. May I request you to speak on the handset mode? Your audio is not very clear.
Is this better?
If you are on speaker, please come on the handset mode and you proceed. Thank you.
Hello, is this better?
Yes, much clearer.
Yeah, just wanted to check on one. So in the fourth quarter, there was a sequential increase in other expenses. So was there any one-offs in third quarter which is now reflected and has come back? That was one. And secondly, sir, would appreciate your thoughts on further trajectory on the yields, basically on the mutual fund business with regards to how are the yields shaping up, especially if you could throw some light on the movement between the legacy assets versus the new assets. That would be pretty helpful.
Sure, Prayesh. I'll ask Parag to answer this.
Thanks, Prayesh, for your question. So on the other expense side, generally the trajectory is in the range of around 55 odd crores. So this quarter there is slightly some expenses on the marketing activities we have done on alternate asset and digital side, which has slightly increased our cost on this end. Plus post the opening of economy and traveling, a lot of events and a lot of traveling has been happening, which has slightly increased expenses. Plus, offices are working as normal, which was not there in earlier quarters, which has taken up expenses slightly up. More or less it will be in the range of around 55 odd crore, which we have seen earlier also. There is slightly bump up in the current quarter due to the quarter year-end pressures or year-end spendings.
Alternative?
Yes, some spend on alternate asset we have done on the marketing side.
Okay. So this kind of run rate, 60 crores kind of a quarterly run rate, is sustainable?
So that is what our
aim would be.
Yeah. In a 55 to around range currently.
Okay. Got that. And on the yields front, how do you see the yields moving ahead, especially in the light of movement between legacy assets to newer assets?
So yields have various composition which impact the overall yield. One is the size, how it goes up, and which asset class is the contribution increases in the overall mix. That depends, but we are hopeful that the yields on overall mutual fund will continue to be in the range of this 41 odd basis here and there, currently which are there. Maybe if the size really goes up, then may see some pressure on equity yields, but we are hopeful that debt yields over the period can compensate to a certain extent.
Sorry. And lastly, if you look at the market share in both equity and debt, we still not seem to be gaining any ground out there. Any thoughts as to what would be the key drivers to improve the market share in both the equity and the debt segments?
Yeah. See, with respect to market share, Prayesh, clearly, while we saw, previous years fall in market share, I think first and foremost, the way I see is the rate of fall got reduced quite significantly in the last few quarters, last 2 quarters. That's one. Secondly, we have seen an increase in contribution coming from the banking channel, which is an organized channel which largely sells on the basis of the product being part of the approved list and so on and so forth. We have now seen improvement in the overall banking channel contribution, which again I see is a sign of movement. And third is the the NFO-led growth versus existing fund-led growth. Last year's significant proportion of the flows were coming to the NFOs. That's why I mentioned in my briefing about 50% of flows came to NFOs. I see the coming year reduced offerings of NFOs, and therefore money would move gradually in the existing funds. We have prepared ourselves in positioning 5 of our products, which are the flagship in the respective categories, and whose performance also been quite good. And even the engagement that we have at the ground level that we are doing in order to build a size in the existing funds in each of the major categories of funds, that's something that should also help us in improving the overall share. And the last, of course, is improve the overall SIP book size, which is close to about 900 crores currently we have. And each month we have been seeing the run rate improving, especially on the registration. I think we continue to keep this high focus. Our endeavor to have close to about 1,000 crores plus in SIP would also lead to an improvement in the overall market share improvement. I think that's one single point agenda that we have in order to build that. The team structure I just mentioned about briefly, I think what we have done in terms of retail team structure. In fact, that has been done keeping in mind the sharper focus that we have to bring in those markets which matter to us, high potential. At the same time, the team can work in a very focused manner, improving the high productivity in the respective market without diluting their attention in looking at all around the place. That's something, again, we have done it in the team structure. So this sharpness in team structure also should help us in bringing in higher productivity or outcome coming from each of these markets as we move forward. In fact, I must mention the retail team after made the announcement, they are quite enthusiastic and energetic as they got the growth, and they also feel that very confident that the coming year we will be able to actually move towards improving the overall productivity. So this is the assumption. And the last is, of course, the fixed income side, I think year-end outflows, which normally happens. As a result of that, you would have probably seen a marginal dip in the fixed income AUM as well, which in my own belief is should again come back as we move forward, given the fact that we are a significant player in that market and should also help in overall the size getting a little better.
Aditya, thank you so much.
Thank you. The next question is from the line of Lalit Dio from Equirus. Please go ahead.
Yeah. Good evening, sir. Thank you for the opportunity. So my first question would be, sir, so we are seeing a strong growth on the ETF and index fund. Now, while we understand that so it's on a current lower base, so do we have like any broad mix in the mind like that we are targeting to increase? Like currently it forms about 2% of the overall AUM mix. So do we have any number in the for ideal mix in the future? And with that increase in the ETF and index fund, do we foresee any pressure on the yields as well?
See, on your first point, I think the way currently we are doing it, whichever number I put, that as a percentage of total assets and management is still very, very small, given the fact that we now want about 9,000 crores size, within a 3 lakh crore size, will still be a small portion of the overall asset management. Given the fact that we don't have the luxury of getting the government-related growth in our schemes. At the same time, the milestone, having now established this base, having now brought in a high level of focus on building passive as one of the separate strategy in addition to the growing our existing funds, active managed funds, definitely the rate of growth that we are looking at from this segment would definitely will target higher amount, but still will not be still a major component of the AUM, and that will only keep rising as we move forward. That's the way I would look at it, rather than measuring the success as a percentage of the AUM, but how we actually rate of growth is coming from the segment, that's something which I will look at as part of the strategy going forward. At the same time, in terms of keeping the profitability, look for opportunities. In fact, we already filed almost about 13 or 14 applications with SEBI, thanks to the regulatory framework does not permit any new funds to be launched between April and June period on the pooling of account compliance requirement which industry is following. I think once it is done, probably once we start getting approval, we will launch some other funds which is more like either con-based funds or maybe a smart beta fund, which will of course help us in getting a little higher margin also on that. As far as the margin pressures due to the rise in index funds, I don't see that becoming a trend at least for next 3-4 years. That's my personal view. Given the fact that as the market gets widened and the probability of money managers delivering return either in line with the index or better than index, they will always come. And that is being the case, I don't see the margin pressures coming on actively managed funds just because of money is actually rather the low-cost funds are being offered to the market. And my own belief is the rate of growth for low-cost funds will be probably higher than the rate of growth for actively managed funds at least for some time. As part of the whole asset allocation strategy, under the asset allocation strategy, I think index funds in all fairness should also be part of the consideration for the investors, which I think as the fund house will offer, distributors also will offer to be fair to the customer. The customer would also have a mix of actively managed funds and index funds and look at the total cost that he is paying rather than they moving only towards the low-cost funds. Therefore, I don't see margin pressures coming on the basis of index, given the fact the size of the fund is still becoming larger. The expense also gets reduced as per the new SEBI guidelines, which got introduced about 3 years back. Therefore, I don't see that as a big challenge. And the last, of course, is the direct plan expenses. Once the size become larger, adjusting for distribution commission, direct plan expenses itself is so attractive. Probably there are any need for somebody to look at for reducing further expenses and go and look for index funds, and therefore putting pressure on the active management expenses.
Sure, sir. And so, like as you mentioned, like we have 14 to 15 products on the in pipeline for on the passive front. So, do we have any products in the active side? Do we have any products in the pipeline?
Active side, we already have one fund which of course filed with SEBI and waiting for approval, which is a multi-asset allocation fund, which of course include commodities as well as part of that, and that's something which we already have. And once the approval comes, we are still hoping to get approval in the month of March, so that we thought we will launch in the month of May. But given the current situation, probably we'll do it in June, July, the second quarter of the current financial year. But in the meantime, it's also an opportunity which I see. I was telling my colleagues as well, and given the fact in April, May, June, NFOs would be less, it's also a good opportunity actually to revive the greater interest on existing funds, which also equally important for the industry to grow, which also I see it as an opportunity actually to create a recall for the existing funds much bigger than what we would have seen in the last year, and therefore improving the contribution of the existing fund itself.
Sure, sir. Thank you, sir.
Thank you. The next question is from the line of Jignesh Shail from InCred Capital. Please go ahead.
Yeah, thank you very much for the opportunity, sir. And pretty much detailed, information you already had given. Just three things. One, can you give us a little bit more details about? Sorry if I missed out, in the opening remarks, but a little bit more broader strategy about how we are planning to do on the alternative side, and how that particular business should see a growth in next a little relatively a longer horizon, 2 to 3 years, and how that will impact our yields. That is one. Second, as you already said that, because of the unlocking and all, other expenses somewhere around 55 crores and all. So the PAT is how the range, what you are seeing it up for next 3 years, to give a little bit a broader idea on that. And finally, any increase you are seeing it on the dividend payout side, or there will be more distribution coming up on the dividend side. If you can give us some clarity on that, that would be really helpful. That is the three questions I have.
Sure. So with respect to your Jignesh on your alternate strategy,
sure.
One, we have created a separate vertical as we have informed in the past. This is comprising of 4 different segments of the market. One, PMS and the AIF space. Second is the passive strategy which is ETF, and the third is within the passive fund also will get included in that. And third is the real estate fund, and fourth is the offshore. With respect to the PMS and AIF, I just mentioned in my opening remark that we are further strengthening our team by way of getting somebody on board whom we have already finalized. And mostly next quarter, once he joins, I'll be able to disclose the name. And once he comes on board, we have a big plan in terms of launching both the closed-ended AIF as well as the open-ended AIF. And also the AIF, which will have a low cost structure at the same time profit sharing kind of model. That's something we'll step up our focus in offering such products to the market. Recently, we of course have a money manager who has joined from Ask James, PMS division. And with this, we are strengthening our team further in order to bring in a higher level of focus on building the size in this, which ultimately, of course, currently we have a size of 2,000 crores. In fact, the peak AUM that we had in PMS was about 5,000 crores about a few years back.
Yeah.
Definitely, we need to go past that number the next few years with respect to the PMS and increase the contribution coming to the segment.
Okay.
Second, with respect to the ETF strategy and passive strategy, which I just explained earlier, with respect to the offshore, we have seen a static growth the last few years. I don't think it can go worse than what we have seen. It can only get better. Given the fact that we already launched the fund which is called Engagement Fund, ESG Engagement Fund, and more such focus that we want to start bringing on the table, including winning mandates from existing customers who have got great experience dealing with us for the last 14 years. I think that probably will give us an incremental AUM, and also see there's an opportunity coming from the offshore business, especially in offering product solution to the global investors. In the infrastructure space, we have been already having informal engagement with one of the leading firms to help us raise money from pension funds to whom we can offer India-related product, especially with fixed income-oriented product, which again have a higher margin coming on that space, given the fact that we have a large team who understand credit market much better. That's something we will do as far as the offshore fund concerns. So, therefore, we have a very clear strategy on the alternate piece in taking it to the next level. And as we see a development happening in this space, I think we'll keep announcing it in each quarter in order to give more clarity on the space. So definitely the intention is to have higher contribution coming on the profitability as well as on the more than AUM, more on the profitability.
Sure.
With respect to the other expenses, Parag, you want to say?
So as I mentioned earlier that our other expenses will be around 55 odd crore or in the last year.
I'm so sorry to interrupt you. Mr. Shell, but your audio is not very clear. I would request you to come closer to the phone and on the handset mode.
Sure. So, our other expenses were in the range of around 55 odd crore in the last couple of quarters, and we are hopeful that it will remain in that range with some inflation impact going forward, which may have, and slightly maybe post alternate asset business going up, there may be some cost on the marketing side of those products may come in, but we are committed to keeping our cost under control as far as possible and keeping it the growth below the growth of the overall growth of the AUM.
So what I understand is that there is a very limited probability of now on an absolute basis cutting down this particular cost because we are already working on the optimized level. So whatever now the PAT improvements are concerned, it has to come up from the top rather than a rationalization of expenses happening. That is what I was coming to. So that understanding is correct, right? So more diversity coming up on top, that will basically give us more PAT yield. I mean improvement on all the profitability.
Yeah, cost-led focus will be, of course, more. If I'm going to make an investment today for the future business, for example, they're building an alternate business, then naturally that will have somewhat of cost. For example, this quarter itself, we have few costs which has come related to the alternate business, where we are increasing the cost now, but it will start delivering in terms of both top line and profitability as we move forward. But those are some other things which should be there. Otherwise, what your assumption is right.
All right. And lastly on dividend.
Yeah. Coming to the last question on the dividend payout, I think we anyway have guided around 50% of our PAT would be kept aside for the purpose of distribution. And though the policy, we are given a broader guidance without giving any percentage of dividend declaration that we do. But you would have already seen in the last 2 quarters, we gave an interim dividend in between, and now we are giving the final dividend, which is 50%. More or less, that will continue. But as the cash balance becomes larger and we don't feel the need for that, I'm sure the subject to the approval of the board and shareholders, and this percentage can definitely vary.
But for at least if I put it for next 3 years kind of an horizon, we should assume it would be minimum 50%, so somewhere between 50 to 60% kind of assumption would be reasonable. Is my assumption correct?
Exactly.
Yeah. Just lastly, being sure you people have been veteran in the industry, and a lot of interest rate tightening is happening a lot. Do you think the demand for debt funds should be relatively muted even going forward, at least near term, and liquid will see a traction? Obviously, equity and ETFs anyhow continue with the broader penetration and everything. But what's your view on debt and equity? Do you think that will still remain a bit of a laggard, at least in near term, and liquid will be more into demand? Just your thoughts on it.
Yeah. I mean, in fact, even the last 2-3 months, there has been a more shift towards short tenor assets or short duration fixed income schemes, which I think our own belief will continue for some time till we actually see the rate hike starts happening. I think once the rate hike cycle begins, and I think once reach certain level, probably you'll be able to figure out some opportunities coming on account of in the fixed income space itself, given the fact actually the bond is already discounting 85 to 100 basis points rate hike.
Yeah.
And the base rate is already discounting the rate hike, whereas the real rate hike has not happened. But as the rate hike happens in real world, and the bond market already discounts the potential rate hike, probably a time will come the next, say, maybe the 3rd quarter or 4th quarter of this current financial year, when the 10-year bond yield is close to about 7.5%. We will see an opportunity coming for investors to come in. At the same time, even the credit fund, as the credit starts picking up and as the spread starts widening, you'll also see a revival of credit funds as we move forward. May or may not happen in the year 2020-23, but maybe in the subsequent years as the spread starts widening. Therefore, a fixed income we probably should start counting for a better recovery going forward in the next 6 months to 1 year period. And for that, during that interim period, we may probably see muted response coming towards fixed income, staying invested between say 3 months to 1 year kind of duration.
This is really helpful, sir. Thanks a lot and all the best.
Yeah, thanks, Dinesh.
Thank you. The next question is from the line of Dipanjan Ghosh from Kotak. Please go ahead.
Hi, good evening. Thanks for the opportunity. Just 2 or 3 questions from my side. First, going back to one of the previous questions on the passive strategy and some of the smart meter products that you intend to launch. What will be the yields on some of these products, if you can comment on that? Second is, in your overall gross active equity flows for the year, if you can segregate that between flows that came in through the direct channel and through the non-direct channel for the overall year or for the quarter. And the third is, you have mentioned that the overall increase in folios for FY 2022 was around broadly around 1 million. If you can also kind of break that as to what will be the overall increase in the number of new PAN accounts that would have been registered during the year. That's all from my side.
Okay. See, with respect to the first question on passive versus smart beta ETF in terms of margin, I think smart beta ETF, I think we are looking at the gross level anywhere around 60 to 80 basis points kind of the gross level. And the net level, we are looking at contribution somewhere around 30 to 40 basis points as a smart beta ETF. I'll just give an example. The we did last year, the Nifty 50 equal weight index, since it involves a frequent revisiting of the portfolio allocations, etc., we actually launched this product with the 1% expenses maximum, and the distributing commission also we kept in that, and then it's contributing close to about 40 basis points net to us. That's the way we built the model. And smart beta ETF will probably have a similar kind of model. Though at this point of time, the entire passive is coming out of relatively 10 to 12 basis points kind of product. And a fixed income product which also comes in the passive category, we have been launching a target return index funds and fixed income space. Also, I have been giving close to about 20 basis points at the gross level. That's something again we continue to do. Maybe the volume will continue to drive our profitability from there rather than absolute margin. And that's something is the broad expectation that we are building in our business plan. With respect to the equity flows, let me just get the, we don't have generally they disclose the number, but I can only say broadly this year we have seen net inflows in our equity schemes through the launch of two open-ended equity funds. Even our existing funds, predominantly in the existing funds like Sun Life Equity and some of our thematic funds, we have seen inflows such as Digital India Fund, Banking Financial Services Fund, even the Gen X or the consumption-oriented fund. Generally, we have seen inflows in the space. But this breakup, Dipanjan, I would get that separately. With respect to the folio increase, of course, I mentioned about 13 lakh folios that we got added. In terms of new PAN number, if I'm not wrong, is close to about 6 lakh, right? 10 lakhs PAN number. Around such new PAN number we added.
Sure. Thank you. Just going back to the second question, I think I was more of looking, not at the net inflow number for the year, but rather trying to understand how much proportion of the gross flows came into the direct channel. If you can, give some color on that.
Direct channel is about 18%. Direct channel is about 18% in the overall asset mix.
This will be on AUM basis, right?
Equity AUM basis, yeah, correct.
Okay. Can you also give this number on a flow basis?
So it's more or less in the similar range.
Okay. Sure.
It will be more or less in the similar range.
Sure. Thank you and all the best.
Yeah.
Thank you. The next question is from the line of Madhukar Ladha from Elara Capital. Please go ahead.
Hello, am I audible?
You're audible, but I would request you to come on the handset mode and come closer to the phone, please.
Yeah, I'm on the handset. So my question is, the staff expenses, again, in Q4, we've seen a little bit of a decline from what was trending earlier. What is playing out of here, and how do we see this line item going forward?
So, Madhukar, on the staff expenses, Basically, there is slightly tuned out of the VPay provision, which has resulted in slight lower cost on in the Q4.
So I did not understand that. Can you just repeat that?
So there is a slightly drop in the bonus provision which we make every quarter.
Understood.
Slightly drop in the overall cost for the Q4.
And can you give what is your total variable pay for the year?
So we don't disclose that number. It is part
Sure.
of the overall cost.
No, I think this mota assumption only we have to make, Madhukar, which is predominantly fixed versus variable. The variable payout generally is about roughly about 20-22% of the 20-25% of the broad kitty of the salary.
Understood. Got it, sir. This is very helpful.
That we have.
Thank you.
Yeah.
Thank you. The next question is from the line of Bhuvnesh Garg from Investec Capital. Please go ahead.
Yeah. Hello. Yeah. Hi. Thank you for the opportunity. So, sir, I would like to know your views on the points of differentiation for an AMC. Like what are the factors that you think would drive a channel partner to sell ABSL fund particularly, or for the customer to demand ABSL fund? And in that scenario, what the company is doing about it, and what kind of results you are expecting of your actions in coming years? Yeah, that's my question.
Yeah. Thanks, Bhuvnesh, for this question. See, the clear differentiation is, I think one is long years of commitment, the track record that we have as a fund house have brought to the table. And second is, as a thought leader in the mutual fund industry, to drive in the forefront, not just working only for our fund, even for the whole industry, has given us a high respect as well as high engagement ground level. That's the first and foremost thing which I would say. Second, of course, having created a good experience, every fund house will go through some bit of ups and downs here and there. I think delivering consistent experience to the customers, not just only in investment performance, even otherwise, in adding value to the distributors across the country, and staying relevant from the customer point of view in the respective product category, as well as one of the best solution provider for the investors. That remains the second point. Third, with respect to the distribution partners, I think the number of engagement activities that we have around the year, 365 days, both in terms of increasing the skill set of the people, as well as working with them closely in adding more customers in every market as part of our penetration. Even the fact that we have gone today, I've got a presence of 280 locations, that continues to remain one of the big area of focus in increasing our geographical footprint. All of them comes as a part of our broad commitment that we have in building this business and serving more growing needs of the customers and distribution community. I think these are some of the things will remain. At the end of the day, we as a fund house are a firm believer of high engagement, high recall for our people, product, brand, and the service that we are able to provide on an ongoing basis, that ultimately will increase the market share. I think that's something which I've realized over a period of time. High engagement ground level is actually the master in providing service to both the distribution community as well as the customers, which will be one of the big differential product, which I call it as hard work. That hard work will have to continue to put more and more each year, passing year, in order to ensure that we as a fund house get our deserving market share.
Thank you, sir. Sir, just a follow-up question on that only. So, do we have any metric to track which track the engagement level, like for example, in daily active user in case of apps, so that time spent by each user on app daily basis? So some kind of metric which we can track to gauge the change in engagement that you just mentioned.
Sure. See, we've introduced on the lines of Salesforce.com, which I think internationally most of the companies use this. And we have introduced one of the local tool, locally created tool that we have introduced called Waymo, which is again being used by some of the large banks in the country in order to provide a greater facility to the RMs in order to making more informed and then making more productive in every market in which they operate. That's something as a fund was introduced last year. In fact, wherever I travel and talk to my salespeople, they all love it because it gives them the greater information that they need on a day-to-day basis to be prepared in the respective market, and then know where is the gap that lies, which distributor need to be connected, which distributor last time they connected where they need to connect more going forward. All such information are provided in the palm itself, the mobile phone. That's something in my own belief is helping them in increasing engagement at the ground level. In order to also give them more about MIS in a tip of their hand, and they're also helping them to know the gap that exists in every market in terms of our activities. And they're also helping them plan much better than the past, which in our own belief is a continuous drive towards this and creating a cultural habit, creating a habit of using these as part of normal activities. And that something will help us in bringing higher productivity from every RM that operates in the country. Basically, the idea is make every RM look inward rather than look outward, and therefore he is only worried about his market, his location which is present, and therefore drive the respective market growth, which you have done it historically in the past very well, but maybe for a brief period, yes, we had seen some slippage, which I see it coming back with this introduction of new tool.
Great, sir. Thank you for that. Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Pranav Tendulkar from Rare Enterprises. Please go ahead.
Hi. Thanks a lot for the opportunity. Sir, if I calculate, just wanted to confirm this. So outstanding SIPs, our share is around 2.57, and in the new SIPs, it's 4.57%. Is that right?
What's your question again?
So in the outstanding SIPs that we have, so I think we have 31.7 lakh SIPs outstanding. And in that we have 2.5% market share out of total SIPs outstanding in the market. And in the new SIPs we have 4.5 market share, 4.5%. Is that right? Because we have around, I think, 324,000 as compared to say 7 million in the industry. So is that right? Is that calculation?
I'll ask Prakash to answer this one.
So, Pranav, this 5.28 crores is the industry numbers, and we have around 31 lakhs, so you can work on the market share.
Correct. And it's the same way I can compare the new SIPs also, right?
In the new registration data, we get it on the AMFI also. So from there also you can get the market share of the new registration.
Correct. So you have included that in your presentation, sir. So yeah. So in fact, that actually concludes that your market share in the new SIPs is much higher as compared to your previous performance. Is that right?
Yeah.
Exactly.
Right?
Exactly.
Right.
It's what we aim. I think that's why historically we have built our SIPs. Each month there has to be higher growth coming in. In every segment we operate, we go and look at what we need to do. If you have to drive our team with high summit of short-term and also encourage them actually to sell more SIPs with a long-term sustainable nature, that's something we keep doing it. I think what you said is exactly on the same line in which we have been building.
Right. So also, out of our AUM, how much of our AUM stands in first 2 quartiles? Can we give us a color in that? And do we track this number?
Yeah. See, I can give you, though we don't generally disclose it, but I can give you mota how does it work.
Right.
See, most of the funds, in fact, in the equity space, almost 75% of the funds in the equity space have delivered Q1, Q2 performance with respect to the comparable schemes in the respective categories. In the case of fixed income, 100% of the funds have been the Q1, Q2. The way we do is each category we look at peer group in the respective categories and then we map it. Therefore, the 1 year basis will be about 70% roughly. On a 2 year basis, it will be roughly about 68%. On a 3 year basis, also will be now close to about 68%. And we have seen a continuous improvement in the last 1.5 years in all our equity funds performance. Again, as we have seen many times the cycle in the market, and this last 1.5 years, our improvement significantly that we have shown in the short-term performance also now start reflecting on the long-term performance. At the same time, of course, if I am better than others, somebody else has slipped, right? There are many people actually also done extremely well on the basis of their performance during the period of 1920. They have seen a significant dip in their performance as well. So I think that's something which goes in a cycle. But as a fund house, we want to focus more on consistency rather than the performance either in the short term or in the medium term.
Right, sir. So also, can you just give me some color on beyond 30 monthly average AUM? I think we have around 460 billion for this quarter. How much of this is equity and debt? Like color, if you can give, is this beyond 30 equity focused market?
It's 75% equity.
Okay. Good, sir. Perfect, sir. I have some questions, but I'll come back in the queue. Thanks a lot, sir.
Thank you. Anyone who would like to ask a question, you may press star and 1. The next question is from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Hi, sir. Again, thanks for the opportunity again. Just wanted to check on slightly longer term outlook for overall equity yield. So resultantly overall MS yield. So we have seen in the last couple of years between FY20, 21, 22 a sharp fall in the yield. Well, there have been multiple reasons for it. But do you see the intensity of this reduction in equity yields to reduce going ahead, and how do we see the yields moving ahead, especially in the equity category? Hello?
Yeah. So, Prayesh, as you also know, the larger the size will be, the lower the TER. So, and a little bit the new flows which come in the scheme currently may come at a slightly higher expenses, underwriting cost compared to the stock. But it totally depends on which scheme it comes, which category it comes, because some of our the brokerage after a certain period keep on dropping as the year passes. Like the first year may be NFO expenses. NFO has the initial higher cost of underwriting, but over the period it will keep on dropping, and which will help us all in reducing the cost of underwriting and improving the yield. So it's difficult to project, but the principle remains same, that sharing will be in the range of around 60-odd%, and we will keep on how the market or the size goes up, it will have a slightly drop in the TER.
Okay, thanks.
Thank you. The next question is from the line of Pranav Tendulkar from Rare Enterprises. Please go ahead.
Hi, sir. Thanks a lot for the opportunity again. Sir, one of the things that is part of customer experience is obviously return, but that's not the end of it. So I would just like you to spend some time on the factors other than the return of customer experience that you are focusing on or are tracking. Thanks a lot.
Yeah. Thanks, Pranav. One, of course, the way even I position is being an asset management company, investment is at the heart of the business, and that goes without saying. And also the risk management that as a fund house, as we start building size, managing business with high governance standards, and also the risk that we need to keep in mind associated with both the delivering consistent performance and portfolio risk point of view, as well as giving the operational benefit that we have to give. I think the other area is actually the one other thing that we keep doing is a constant communication engagement with the existing customers as well on a quarter-on-quarter basis. in adding value to them. One, on the basis of various opportunities that one could see in the market more as part of the learning initiatives. The University Education Initiative, as you mentioned about, is one of the highest. We are the number one fund in the country. It's again ranked as the best among all the mutual fund players in the country. That's something we have now brought in a high emphasis the last 7-8 years. Second is the on the service initiatives. We have a theme called 12 by 12 project. We call it within a few hours of any query that comes from the customers need to get resolved within a matter of 12 hours. And that's a mandate that has been giving to the entire customer service team as part of the speed to the market initiatives. There are many such small initiatives in our own belief will help us in differentiating ourselves as a fund house who could have a higher mind share of the customers in addition to the experience that they get on putting the money in the investment side. At the end of the day, we believe in adding value to the customers, even making the customers aware about the value-added product that we have, value-added service we have, but most of the services are meant for creating ease of doing business for the customers. But many times investors don't use these value-added service, value-added product to find a solution or maybe ease of transaction for their needs. That's something, create an awareness about them and make customers utility value go up significantly on these exercise is something remains one of the core area of focus in addition to focus only on the investment-led growth.
Thank you. We lost.
I hope it answers your questions now.
So we lost his line, unfortunately.
Sure.
Thank you. As there are no further questions from the participants, I now hand the conference over to Mr. A. Bala Subramanian, MD and CEO, for closing comments.
Yeah. Thank you very much, and ladies and gentlemen, for logging in today. And with this, we conclude our Q4 FY22 earnings call. Do feel free to reach out to us through our IR head, Mr. Prakash Gokhale, for any queries that you may have. And I look forward to seeing you soon. Thank you.
Thank you. On behalf of Aditya Birla Sun Life AMC Limited, concludes this conference. Thank you for joining us, and you may now disconnect your lines.